India's equity markets have been on a tear. But what's fueling this rally and what should your strategy be as investors? To chat about this, I have with me Harsha Upadhyaya, the Chief Investment Officer for Equities with Kotak Mahindra Asset Management Company Limited. Harsha, hi. Thank you for joining us. Let's start off then by talking about this massive surge we've seen in Indian equities. What's fueling this rally? We're on the verge of probably hitting that $5 trillion market capitalization mark soon. What's your take?
See, for equity markets, three things are very important: fundamentals, flows, and sentiments at all points of time. At the current juncture, I think all three have come together and there seems to be no visible negative at this point of time. If you look at the fundamentals, whether it is economy or corporate fundamentals, they have all been very, very strong. Despite challenges that we have seen in the global markets, Indian corporates and Indian economy have done much better, have been much more resilient. So to that extent, no real negatives that are visible in front of us. If you look at flows, clearly domestic money has been very, very sticky and has been steadily coming in. We have also seen foreign institutional investors putting in a lot of money in 2023, although 2024 has not started on a well note. But I would say that over a period of time, we can expect reasonable flows from even foreign shores. So to that extent, even the flow structure seems to be quite strong at this point. And finally, sentiments. I think after state election results, after budget, etc., the sentiments have only turned more positive as compared to where they were earlier. So clearly, all three things have come together and markets have definitely moved up much beyond what most people expected maybe a couple of months earlier. The only red flag is, along with markets moving up, the valuations have also moved up. So to that extent, the volatility could increase as we go ahead into the next quarter and next half year.
Now, we have geopolitics on one hand, where things are not looking good. Crude is hitting $80, $81 per barrel. But we also have domestic factors, like you mentioned about elections. In which way will Indian equity markets move? What's your outlook for the next, few months?
Clearly, as of now, it seems like global factors will probably be a bigger risk factors to India at this point of time. There doesn't seem to be any visible negative in our economy or in our corporate landscape at this point of time. Yes, coming to equity markets, the valuations have been very expensive, especially at the broader end of the market. So to that extent, the valuations themselves could lead to higher volatility as we go ahead.
Let's talk about FII flows then. India's weightage in the MSCI EM basket has increased quite considerably. We are very close to China now. Do you see the weightage increase turn things around in terms of FII flows?
Clearly, that's been a very, very encouraging factor for somebody who's looking at foreign flows into India. If you look at India weight in the emerging market basket, let's say a decade earlier, it was a meager 3-4%. So to that extent, one could have ignored Indian markets for whatever reasons. And even when India would have performed much better than other markets, they wouldn't have really faced any issues in terms of underperformance or drag on the portfolio. But today, nobody can ignore India. India's weight is the second largest in the emerging market basket. It stands at around 18%. So clearly, it's a large market, whoever wants to invest in the emerging markets at this point of time. The second is the Chinese weightage has also been steadily coming down because their markets have been underperforming and other markets like India have been outperforming. So their weightage has come down to about 24%. But the bigger issue here is there are a couple of other markets which are slightly lower than India in terms of the weightage, but collectively they may be about half or a little more than half of the emerging market basket: China, Taiwan, and Korea. And all three seem to be more dependent on exports growth for their economy to sustain the current growth rates or improve on current growth rates. Whereas India is not in the same boat. So to that extent, as long as we continue to be more resilient as far as domestic growth is concerned and our economic fundamentals continue to be strong and corporate earnings growth continues to be at a reasonable trajectory, then I think our weightage can remain high or can even move higher. So at this point of time, clearly no emerging market investor can avoid India, and they will have to look at India even if they are negative on valuations. Some investors may feel that India has been expensive. So to that extent, every now and then you may see some tactical shift that is happening out of India into other markets. But when you look at the long-term structural growth, India continues to be really one of the preferred destinations. So to that extent, I would say India will continue to attract foreign investors over the next few years.
All right, so India's valuations are expensive, but I guess in many ways we do deserve the valuations we are commanding. So to encapsulate this entire conversation, tell us what are the themes you're watching out for, and what's your advice to investors?
We have been suggesting investors to keep a little bit of large cap tilt in their portfolio, simply because the relative valuation comfort is more on the large cap side as compared to mid and small cap sides. We are not saying that don't invest into mid and small caps, but when you are coming into mid and small caps, please be aware of the valuation risk and also come more from a staggered perspective rather than lump sum mode is what we are suggesting. And if you look at themes, we are clearly very positive on the manufacturing theme, which we think over the next 5-7 years can really grow into a larger basket of companies, as well as a lot bigger opportunity from a stock market perspective. So I would say if somebody is looking at a 5-7 year kind of a thematic exposure, manufacturing could be one such exposure.
Thank you, Harsha, for joining us. Large caps and manufacturing, that's something that you must watch out for, according to Harsha Upadhyaya. Thank you so much for watching, and stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.